It's been a long week. I'll try to give you the highlights and I'll give them to you in reverse order. Perhaps the most important long-term development was the latest payroll numbers from the US. We're giving you the two main points from that on this chart here. You can see that both the unemployment rate, which is down to 5.4%, and the ongoing increase in non-farm payrolls, which is done by a separate survey, both of those show that we are now firmly back into what you might call average realm. There are many reasons to think that the data might be somewhat weaker than it appears, for example, through the high rate of long-term unemployment, the amount of underemployment, but still we are not at the kind of levels in the labour market which justify on their own such incredibly low rates as we've seen recently. That means that many still think that there is some possibility of a rate rise from the Fed next month. I myself think that's unlikely. The balance of people on the market seem to think that's unlikely because the S&P closed today almost exactly equal to its previous all-time closing high. Now, we also had a remarkable cliff-hanging election in the UK, which was supposed to be on a knife edge but turned out not to be. The Conservative victory was market friendly, and you saw sterling rise 1.4% as a result. Perhaps surprising that it wasn't even more than that, but we do now have the new uncertainty over the European membership referendum to look forward to. The most important development within markets themselves came in the bond market. We saw a remarkable correction from what had been historically low yields across the world, followed by what looks as though it may have been a moment of capitulation on Thursday. This is what's happened to the 5-year German Bund yield over the last year. You can see it's been in negative territory for much of this year, and that the rise in yields over the last week or so would have inflicted losses on more or less anybody who had bought piling in earlier in the year. You have similar figures in the 10-year, where there was a very sharp spike in yields on Thursday, followed by a sharp retraction. That might indicate that that was the end of this correction, that this isn't the beginning of a new trend, merely a correction. That's probably the most important data point to look out for next week. There won't be that much in the way of earnings data or of economic data. Wither the bond market. It gives us a very critical idea as to where world markets remain rather finely balanced, where they are heading over the next few months.